The Fed has cut rates again, and if you're wondering what that means for your wallet, stick around because today we're breaking it all down. Hey, what's up, everyone? Don't forget to like this video if you find it helpful and subscribe. Let's get into it. Alright, here's the headline. The Federal Reserve just announced another quarter-point rate cut, 25 basis points. That's the third consecutive cut since September, totaling a full percentage point in reductions. Sounds like good news, right? Well, not so fast. While the Fed's move aims to ease financial strain after a brutal period of rising borrowing costs in 2022 and 2023, the relief might not hit your wallet right away. Why? Rates went up fast, 11 hike in just over a year, but they're coming down at a snail's pace. Plus, most people are still feeling the sting of inflation. In fact, nearly 90% of Americans still see inflation as a problem, and 44% think the Fed hasn't done enough. So, while rates are falling, it's not time to pop the champagne just yet, but stick with me. By the end of this video, you'll know exactly what this means for your credit cards, car loans, mortgages, savings, and more. First stop, credit cards. If you carry a balance, you already know high interest rates are brutal. Average APRs skyrocketed from around 16% to over 20% since the Fed's rate hikes began. So what happens now? With this new rate cut, your APR might drop slightly, but we're talking pennies here. A quarter-point cut might only shave a few dollars off your monthly bill. Instead of waiting for minimal changes, here's the play. Consider a 0% balance transfer card or a lower-interest personal loan to consolidate debt. Even better, call your credit card company and negotiate a lower APR. You'd be surprised how often this works. Small moves like these can save you way more money than waiting on the Fed. Next up, auto loans. If you're in the market for a car, buckle up because rates are still high. Borrowers for used cars face an average rate of around 13.76%, and new car buyers aren't much better off at 9.01%. Here's the catch. Car loans are usually fixed-rate loans, meaning they don't change when the Fed makes cuts. So what can you do? Shop smart. Take the time to compare loan offers before you buy, even if it means calling multiple lenders. A better loan term could save you thousands over the life of your loan. Remember, even a small rate difference, like 1%, makes a big impact on a major purchase like a car. Now let's talk about mortgages. You'd think a Fed rate cut would mean lower mortgage rates, right? Well, not quite. Fixed-rate mortgages, like the popular 30-year loan, are tied to broader economic factors like Treasury yields, not the Fed's rate directly. In fact, the average 30-year mortgage rate recently ticked up to around 6.75%. Here's the takeaway. If you already have a fixed-rate mortgage, this won't affect you. But if you're house hunting, even slight drops can add up. For example, locking in a rate just a fraction lower could mean thousands in savings over the life of your loan. Shop around for lenders and always compare rates. It's free, and it pays off. Moving on to student loans. If you have federal loans, you're in luck. Most of those rates are fixed, so the Fed's move won't change much. But if you have private loans, especially variable rate ones, you might see a small drop in your monthly payments. Over time, it could make sense to refinance into a lower fixed-rate loan. Just be careful. Switching from federal to private loans means losing benefits like deferment or income-driven repayment plans. On the flip side, savers, there's still good news. High-yield savings accounts and CDs soared during the rate hikes, with top savings accounts paying around 5%. Even as rates drop, banks won't lower these yields overnight. So if you're sitting on extra cash, now's a great time to take advantage of these accounts before rates dip further. So what does all of this mean for you? The Fed's latest rate cut might not be a game changer yet, but there are smart moves you can make right now, whether it's consolidating credit card debt, shopping for better auto loan terms, or locking in mortgage rates and high-yield savings. Hit that like button if you found this video helpful, and subscribe for more tips to make your money work harder for you. Drop a comment below. Are you feeling the Fed's rate changes yet? Let me know, and I'll see you in the next one.